Welcome back to Theta Fuse. I hope you aren't staring too closely at your P&L statement this morning.
Probably not a good idea.
Yeah, if you are, you might want to just close that browser tab, grab a second cup of coffee.
Make it a third.
Hell, maybe make it an Irish coffee and just take a deep breath. Because we are wrapping up January 2026 with some absolute fireworks.
Fireworks is a very polite way to put it. I'm looking at the heat map right now, and it just looks like a crime scene.
It does.
It is Friday, January 30th, and the market has woken up and chosen violence.
Absolute violence. I got my growth screens up, and usually, when I see this kind of red, I'm rubbing my hands together and thinking, okay, flash sale, time to go shopping for tech. I see a dip, I want to buy. But then I look over at you, and you were just staring at the commodities desk with that look on your face.
What lick?
I told you so. Look. That look that says, you kids in your growth stocks don't understand how the real world works.
It's not an I told you so look. It's a concern look. I mean, there's a difference between a healthy pullback, a dip, as you call it, and a liquidation event.
Okay.
And what we are seeing this morning in the metals market, specifically gold and silver, isn't just, pricing and new information. It's leverage getting blown out.
Margin calls.
It's margin calls. It's a rush for the exit where the door is way, way too small.
We're definitely going to get into the grisly details of that metals crash in a minute.
Perfect, too.
And we have to, because gold breaking $5,000 is just... It's historic.
Right.
But we have to set the table first, because this isn't happening in a vacuum.
No.
We have a massive earnings beat from Apple that the market is apparently treating like a funeral.
Which is a fascinating disconnect in itself. We need to unpack that.
A huge disconnect. And then we have the catalyst for all of this chaos.
Sure.
The Fed news. President Trump finally stopped teasing us, and he dropped the name.
He did.
Kevin Warsh, the next chairman of the Federal Reserve.
And that single notification on Truth Social basically flipped the entire table on the global macro trade.
It really did. So that is what we're doing today. We're going to try to parse the signal from the noise here. Is this the top? I mean, is the bull run over? Or is this just a classic shakeout designed to get you to sell your NVIDIA and your Apple right before the S&P marches to 7,000?
Well, we're sitting right at the door. I mean, literally. Futures are at 6,969 as we speak.
Right at the door. And we're also going to dig into a story that I think is getting totally buried under the macro panic. Apple made a quiet $2 billion acquisition of a company called QAI. And when you read what this tech does, well, let's just say it borders on telepathy.
Or it borders on dystopian surveillance, if you ask me. But yes, we'll get there.
And finally, we have to talk about the data point you sent me this morning.
The elephant in the room.
The insider selling numbers. It's ugly. But let's start with the immediate pain. Let's talk about the war shock.
Let's do it. So the announcement comes out, not through a press conference, of course.
Of course not. It was a post on Truth Social early this morning.
Right. President Trump announces he's nominating Kevin Warsh to succeed Jerome Powell. And he called him central casting.
Which is such classic Trump phrasing, isn't it?
It's perfect. It's exactly how he would describe him.
It really is. He said, quote, "I have no doubt that he will go down as one of the great Fed chairmen, maybe the best." And he added that Warsh will never let you down.
Central casting is actually a perfect description for Warsh. He looks the part. He sounds the part. He's a former Morgan Stanley banker. He was on the Fed board before during the '08 crisis era.
So he's an insider.
He is the establishment pick in a tailored suit. He's not some outsider.
Okay, but the market reacted like he was an alien invasion. I mean, just look at gold.
It's brutal. Absolutely brutal. Gold was hovering comfortably above $5,300.
Yeah, it looks strong.
Looked very strong. As soon as the name Warsh hit the wires, the trapdoor opened. We crashed right through the $5,000 psychological support level.
And that 5,000 number was a huge line in the sand.
A massive one. We're now trading at, 51 to 50? No. Down over $200 in a single session. That's an 8% move in an asset class that usually moves like 1% on a volatile day.
An 8% move in gold. That is a lot of leverage getting completely wiped out.
Oh, yeah.
When you see a move like that in a major commodity, that implies that funds are blowing up somewhere.
Oh, absolutely. But silver is even worse.
Of course.
Silver is the high beta version of gold, right? So when gold sneezes, silver catches the plague.
And it got the plague today.
Yeah.
Silver plunged more than 16%. It fell below $100 an ounce. We're seeing it trade toward 96. I mean, that's not a correction, that's a crash.
That is a bloodbath. And it wasn't just the precious metals. Platinum tumbled more than 10%. Copper.
Copper, which has been on this insane tear.
Insane. It had just surged above $14,000 a ton yesterday, driven by the whole AI electrification thesis.
Right, the data centers need all the copper.
And it dropped more than 3% in London. So this was a broad-based commodity rout, all triggered by one name.
Okay, so let's explain, like I'm 5 for a second here.
Go for it.
Because intuitively, this confuses people. It confuses me, frankly. Trump has been campaigning aggressively for lower rates. He wants cheap money. He explicitly said his litmus test for the role is someone who thinks you have to lower interest rates. Warsh is Trump's pick. So logic follower. Warsh must be planning to cut rates. If he's going to cut rates, shouldn't that be good for gold and bad for the dollar? Why is the market reacting like he's Paul Volcker reincarnated?
That is the million-dollar question, or in this case, the trillion-dollar question.
Which just makes no sense on the surface.
It only makes sense if you look at the mechanism of the dollar and yields first. Forget gold for a second. As soon as the news hit, the dollar index, the DXY, spiked. It's up about 0.5% to around 96.40, and at the same time, Treasury yields climbed. The 30-year yield led the gains, up about 5 basis points.
Okay, so mechanism check. A stronger dollar makes metals, which are priced in dollars, more expensive for foreign buyers. So demand drops, price drops.
That's the mechanical reason, the simple math. But the psychological reason, the reason why the dollar spiked, is all about expectations. You have to understand that the market had been betting heavily
on someone else.
On Rick Ryder from BlackRock.
Right, the betting markets had Ryder as the clear favorite just a few days ago.
And Ryder was viewed as the ultimate dovish pick. The market thought Ryder would come in and just keep the money spigot wide open. He's a BlackRock guy. He understands asset inflation.
Keep the party going.
Exactly. Warsh, on the other hand, is viewed as the traditional option. But more importantly, and this is the key, Warsh is a chameleon.
A chameleon. Explain that.
Yes. And this is what I'm calling the Warsh paradox. To understand why gold is crashing, you have to look at Warsh's actual track record, not just who appointed him.
So ignore the politics, look at the history.
Look at the history. And Kevin Warsh is historically a hard money guy.
Okay, unpack that for us. What does a hard money guy actually believe?
Historically, Warsh is a hawk, a serious hawk. He has been highly critical of the Fed's current approach, of Powell's approach. He wrote an op-ed in the Wall Street Journal last year where he absolutely tore into Jerome Powell for missing the persistence of inflation.
Which, to be fair to him, Powell did miss. Remember, transitory.
Right. It was the biggest policy mistake in a generation, and Warsh was calling it out. But his economic philosophy is distinct. He rejects this idea that inflation is caused by workers getting paid too much or the economy growing too fast.
So he's not a Phillips curve guy.
No. He argues that inflation is caused when the government spends too much and the central bank prints too much money to enable that spending.
So he's a fiscal hawk. It's a monetary phenomenon.
Exactly. He believes inflation comes from the central bank printing too much money to cover the government's tab. Full stop.
So if I'm a gold bug,
Yeah.
I bought gold precisely because I think the government is going to print money forever to pay off its insane debt.
Exactly. Gold is the hedge against the printing press. Now suddenly you have a guy coming in who says, I hate the printing press. I think it's the root of all evil.
Okay, I see it now.
If you believe he's going to actually turn off that liquidity tap to fight inflation, well, you don't need to hold as much gold anymore.
So a hedge is getting sold off because the danger it was hedging against might be going away.
That's the interpretation driving this massive sell-off. The market looked at Warsh, it looked at the alternative, Rick Ryder, the dove, and realized it was positioned completely wrong.
It was a crowded trade.
A very crowded trade. Ryder was the keep the party going guy. Warsh is the strict father coming home early and taking away the credit card.
That makes sense. But wait a minute, you called him a chameleon. Because there's a huge twist here. Warsh has been cozying up to Trump recently with a very, very different argument.
This is where it gets really interesting, and this is why I think the market is just whipsawing so violently. Warsh has pivoted.
So
He started talking about AI.
the magic word. Of course. If you want a job in 2026, you just say AI 3 times in a mirror and you get hired.
It's pretty much that. Warsh has been arguing recently that the Fed should discard its stagflation forecast because they are completely overlooking the impact of AI.
Interesting.
He believes AI will be such a significant force that it boosts productivity so much that it naturally pushes down inflation.
The productivity deflation thesis. I love this theory. It's so elegant.
It's the idea that if AI makes us, say, 50% more efficient, we can produce goods and services much, much cheaper. If things are cheaper, inflation goes down. It's a positive supply shock.
So he's telling Trump, we can cut rates. We can have our cake and eat it too. Not because we want to just print money, but because the economy is about to get so hyper-efficient that we don't need high rates to stop inflation.
Precisely. And because of that belief, he has aligned with Trump's goal, arguing publicly for lower rates. He's giving Trump the intellectual framework to justify the policy he already wants.
So which is it? Is he a hawk or is he a dove?
That is the uncertainty. The market isn't sure. Is he going to cut rates because he truly believes in the AI miracle? Or is he a hard money guy in disguise who's going to be tough on the money supply because he hates government spending?
And he's just saying the AI stuff to get the job?
Maybe. The volatility we are seeing, this whipsaw, is the market trying to price in two completely contradictory versions of Kevin Warsh at the same time.
And when the market is that confused, it just sells.
Yeah.
It de-risks.
It sells the winners. And gold and silver were massive, massive winners leading up to this. They were parabolic. This is a classic liquidation break. Funds are dumping their winners to raise cash because they don't know what the rules of the game are anymore.
It really feels like a regime change. Okay, let's pivot from macro to micro to the equity side. Because if the gold crash is about the Fed, the action in tech is about something much more tangible. We have to talk about Apple.
The report that broke the internet and then completely confused it.
I mean, I looked at the headline numbers last night, and I thought we were going to open up 5% easy.
The numbers were good.
They were great. Revenue.
Yeah.
$143.8 billion. That beat estimates of $138.4 billion. EPS, $2.84, beating the $2.68 estimate. But the real story, the number that jumped off the page for me, was the iPhone revenue.
It was a big number, a very big number.
It was an all-time record. $85.3 billion in iPhone revenue. The analysts were only expecting $78.3 billion. They blew it out of the water by $7 billion.
That is a significant beat. You can't argue with that.
And the cherry on top, China.
The turnaround.
Exactly. For the last year, maybe more, all we've heard is Apple is dead in China, Huawei is taking over, patriotism is killing the iPhone. Well, guess what?
What happened?
Sales in China hit $25.5 billion. That is up nearly 38% year over year.
That is a surprise. I'll admit the consensus was that the decline would continue or maybe just stabilize. A 38% jump completely reverses the trend of decline we saw in 3 of the last 4 quarters.
The Apple is dead in China narrative is officially dead. So with all of this record sales, China booming, beating top and bottom lines, why is the stock trading at $256? Why is it red today?
Because you're looking at the past. The market is a time machine. It's always trying to price the future. And Tim Cook gave us a glimpse of the future on the earnings call that the algos did not like.
You're talking about the margin warning.
Yes. This is where the theta view comes in. Revenue is vanity. Margin is sanity. And Tim Cook explicitly warned on the earnings call that the global memory chip shortage is going to hit the company's margins going forward.
The memory crunch.
Right. We know there is an insatiable demand for memory chips right now, and it's driven entirely by one thing.
The AI data center build-out.
Exactly. Everyone needs HBM high bandwidth memory. Everyone needs the latest NAND flash. Microsoft, Google, Meta, Amazon, they are building these massive city-sized data centers to train their models.
And those data centers are just a giant vacuum sucking up every memory chip on the planet.
Exactly. And here comes Apple trying to build 100 million iPhones, and they need memory too. But now they are competing with the data centers for that same limited supply.
And the data centers have deeper pockets and a more urgent need, arguably.
They do. And because the supply is limited and the demand is insatiable, to quote the SanDisk CEO, the price of these components is skyrocketing.
And Apple is stuck in the middle.
Apple is stuck. They projected gross margins between 48 and 49% for the second quarter. Their Q1 margins were 48%.
So flat.
Flat. They cannot expand their profitability because their input costs, the cost of goods sold, are rising.
So even if they sell more phones, it costs them more to make each individual phone, which eats the profit.
And in this market environment, with valuations where they are, if you are not expanding margins, you are not growing profit fast enough to justify a higher stock price. That is why the stock is flat to down. Hardware margins are the ceiling on the stock.
It's interesting that they basically admitted they have to eat the cost. They're not trying to pass it on to the consumer yet.
You may not be able to. I mean, pricing power has its limits. You can only charge so much for a phone before people just stop buying or they wait another year. But the memory manufacturers, they have unlimited pricing power right now.
This brings us perfectly to the next point. If Apple is the victim of this shortage, who is the winner? Who's the predator?
Well, there's one big one, SanDisk.
SanDisk, SNDK. Forget Apple. Look at this chart. The stock is up nearly 20% in the pre-market.
And that is on top of an already massive run. It's just incredible.
It's up 127% year to date. I'll repeat that. It is January 30th. It was the best performing stock in the S&P 500 in all of 2025, and it has already doubled that performance in 1 month.
This brings us back to the memory shortage. SanDisk is the shortage. They are the ones with the pricing power.
Explain the earnings here, because they weren't just good, they were monster numbers.
Adjusted earnings came in at $6.20 per share. The estimate was for $3.44.
So they almost doubled the profit expectation.
Almost double it. Revenue was $3.03 billion versus a $2.67 billion estimate. A solid beat.
But the profit,
Yeah.
it's just absurd.
And look at the breakdown. This is the key. Data center revenue was up 64%, quarter over quarter.
That is the magic number. That is the AI spend right there.
The CEO, David Goeckeler, he used that exact word, insatiable, to describe the demand. He specifically said on the call, we cannot make them fast enough.
So SanDisk is the predator, and Apple, the biggest, most powerful company in the world, is essentially the prey in this scenario.
In this specific supply chain dynamic, yes.
Right.
The leverage has completely shifted upstream to the component makers. SanDisk can look at Apple and say, oh, you need NAND flash for the iPhone 17. The price just went up 30%. Take it or leave it.
And Apple has to take it.
They have to take it. And that eats directly into Apple's margin. That is the entire story in a nutshell. That's why SanDisk is up 20% and Apple is flat. SanDisk is literally stealing Apple's future profit growth.
It really is a pick and shovel market, isn't it?
Yeah.
The guys making the components are the ones buying the yachts, not necessarily the guys selling the final product.
It is. But, and you know, there is always a but with me.
Here it comes, the wet blanket.
Well, before we get to the broader wet blanket, we have to talk about the other side of Apple's report.
Right.
The technology side. Because while they are struggling with hardware margins, they are making some very interesting and some might say desperate moves in AI.
Oh, you mean the fact that they basically admitted they're lagging?
Lagging is putting it very politely.
They're lagging Samsung. They admitted on the call that the revamped Siri, which had been promised since 2024, is delayed again due to quality issues.
Which is becoming a running joke.
It is. And they are relying on Google's Gemini models via their cloud partnership to do all the heavy lifting for the Apple Intelligence features.
It's a bit embarrassing, isn't it? For a company that prides itself on vertical integration, they build their own chips, but they can't build their own brain.
Yeah. They're using Google's brain and struggling to find memory chips in the open market. They look surprisingly vulnerable.
Vulnerable, yes, but still a cash machine. However, speaking of AI and creepy tech, there was a buried headline in all of the Apple news that we absolutely have to dive into. This is my favorite story of the week.
I knew you'd love this one. The sci-fi stuff.
I do. Apple quietly acquired a startup, a company called QAI.
For $2 billion.
Yeah.
Not exactly a small purchase.
$2 billion. Now, what does QAI do? According to the reporting, their technology reads facial skin micro movements.
Which sounds incredibly dystopian to you, I'm sure.
It does.
But to me, it sounds incredibly cool. The use case they're floating is for nonverbal discussions with an AI assistant.
Think about what that actually means, though, for a second.
I am thinking about it. Imagine you're wearing your smart glasses or you're just looking at your phone. You don't have to talk. You don't have to type. You just react. You make a micro expression, tiny touch of your cheek. And the AI knows you want to scroll down or that you're interested in that ad or that you want to dismiss a notification. It's seamless.
Or it knows you're lying.
What? Where did you get that?
That's the part that gets me. It reads micro movements. This is essentially lie detector technology built into a consumer
That is
interface.
a leap.
Is it? If the AI can read a twitch of your cheek to know you want to close an app, it can also read a micro expression of fear or hesitation or deception when you're talking to someone on FaceTime.
Okay, sure, if you want to go full Black Mirror with it. But think about the interface. It removes the friction of language. It's basically telepathy. It's the ultimate connection between human and machine.
It's surveillance, it's biometric data mining on a level we haven't even conceived of yet. And from a pure business perspective, I have to question the price tag. $2 billion for a feature, when they are already leasing the actual intelligence models from Google.
It's not just a feature, it's the input method, the user interface. If Apple owns the way we communicate with AI non-verbally, that's a massive moat. That's a platform. But I do get your point. It is expensive.
It feels like they are throwing money at the problem because they missed the boat on the foundational models. They can't build Gemini, so they buy the company that reads your face while you use Gemini. It feels reactive.
Maybe. But speaking of Gemini and the foundational models, we saw another headline this morning that fits right into this whole puzzle. Microsoft signing a $750 million deal with Perplexity.
Yes, another piece of the puzzle.
So Perplexity, the AI search startup that everyone loves, the one that's supposed to be the Google killer,
Right.
is going to use Microsoft's Azure and their Foundry service to deploy their models.
And note that Perplexity uses models from a bunch of different companies, OpenAI, Anthropic, XEI. But to run them at scale, they are paying the toll to Microsoft.
So even the startups that are supposed to disrupt Google are just paying the big tech tax to either Microsoft or Amazon.
It completely confirms the thesis.
Yeah.
The infrastructure providers, Microsoft with Azure, Amazon with AWS, and the chip makers like SanDisk, they are the ones winning the gold rush.
And the application layer, like Perplexity, or the hardware integrators, like Apple, they're the ones fighting for margins and getting squeezed.
The value is accruing to the picks and shovels. It's the same story over and over again in this AI cycle.
Okay, so we have Warsh crashing the metals, SanDisk crushing the earnings, Apple reading our minds, and Microsoft collecting the toll from everyone. It sounds like a bull market for the right stocks.
It does. It absolutely does.
Yep.
But
Here it is. I was waiting for the but.
we have to look at the broader sentiment. We have SanDisk going parabolic, up 127% in a month. That's not normal. We have S&P futures hovering near 7,000, literally at 6,969. Markets are at all-time highs. Retail investors are euphoric about the Apple China numbers and the AI boom.
And why shouldn't they be? The trend is up. Don't fight the tape, right?
Because the people running these companies, the insiders, are heading for the exits.
You're talking about the insider selling data.
It is the elephant in the room. Bloomberg ran the numbers this morning. In the month of January, almost 1,000 corporate executives sold shares in their own companies.
Okay, but people sell stock all the time. They need to buy houses, pay taxes, buy yachts, fund a divorce.
Okay, fair point. But compare that to the buyers. In the same period, only 207 executives bought shares. The sell-to-buy ratio is the highest it has been in 5 years.
5 years. So since before the last bear market, since before the COVID crash.
Exactly. These CEOs and CFOs and board members, they know their business is better than anyone. They see the insatiable spending on AI that SanDisk is bragging about. But they are asking the hard question. What is the return on investment?
They're questioning the ROI on all this AI spending.
They are harvesting gains. That is the polite Wall Street term for it. They are looking at these valuations, S&P near 7,000, and they are cashing out. They are saying, thank you very much, retail investors, for bidding our stock up to this level. Here are my shares. Good luck.
But isn't it possible they are just wrong? Insiders sell early all the time. They sold all the way up in the dot-com bubble, too. Just because a CEO sells doesn't mean the stock is going to crash. Maybe they just want to diversify their wealth. It's the prudent thing to do.
They might be early. That's always a possibility. But you have to combine the signals. It's not just the selling in isolation. You have to combine the insider selling with what we saw in the metals market today.
The crash.
The gold crash signals a major return of volatility. It signals that the global liquidity picture is changing because of this guy, Kevin Warsh. At the same time, the memory shortage signals a return of inflation in the supply chain.
Okay.
And now you have the smart money, the insiders, quietly leaving the casino while the music is still playing.
So you think the risk reward at S&P 7,000 is just terrible?
I think when the insiders are selling at a 5-year record pace and the geopolitical situation is, well, let's just say, fluid,
Yeah.
you have to be extremely careful.
Right, we didn't even touch on the trade war stuff deeply, but Trump is threatening 50% tariffs on Canada over those Bombardier jets.
And decertifying Gulf Stream competitors, which is another whole can of worms.
And new levies on Mexico regarding their oil deals with Cuba. It's not exactly a calm, stable world out there.
The world is not stable. The supply chains are tight. Inflation concerns are resurfacing with Warsh, or at least confusion about inflation policy is. And yet, stocks are priced for absolute perfection. What happens if Apple misses a margin target by a little bit? Or if SanDisk says demand is slowing down even 1%? What happens to the market?
We get a correction. A fast one.
We get a liquidation, just like we saw in gold this morning, a rush for that same tiny door.
Okay, so let's summarize our positions here, because it feels like we are looking at the same screens, but seeing two completely different movies.
Go ahead. Lay out your case.
I am still bullish on the AI supercycle. I think that's the dominant theme. You just have to look at SanDisk. That demand is real. It's not hype. It's revenue. It is billions and billions of dollars being spent right now. And I think the Apple turnaround in China is the real story. That 38% growth is a signal that the global consumer is still alive and still wants the best tech. I'm looking at that cute AI acquisition and thinking, Apple is building the future interface.
Yeah.
I want to be long innovation.
And my view is that I'm bearish, or like highly cautious. I think the Kevin Warsh nomination popped the asset bubble in metals, and equities might be next. When liquidity expectations change that drastically, asset prices have to reset. I look at Apple and I see margin compression. I see them getting squeezed by their own supplier, SanDisk. And most importantly, I look at that insider selling ratio, 1,000 sellers to 200 buyers, and I see a canary in the coal mine. The people who run the show are getting out.
That is a stark contrast.
It is, and that's what makes a market, right? A buyer for every seller.
I want to leave the listeners with one final thought, something to chew on over the weekend as they're looking at their bruised portfolios. We talked about Apple buying this face-reading AI for $2 billion.
The micro movements, the creepy stuff.
Right. Apple is spending billions to read our faces. They want to know what we are thinking before we even say it. But at the exact same time, its own executives and executives all across the S&P 500 are selling stock at record rates. So here's the question. Are they reading the market's face?
Ooh, that's good.
Are they seeing fear in the market's micro expressions, where retail investors only see greed? Are they looking at the micro movements of the economy, the chip shortage, the tariff threats, the Fed confusion, and seeing a crash coming that the rest of us are missing?
That is a chilling thought. If the insiders are reading the micro movements of the economy and they are hitting the sell button, maybe we should pay attention to their nonverbal discussion.
Exactly. Maybe the loudest signal isn't what they say on the earnings call, but what they do with their own portfolios. All right, that's it for this deep dive. It's going to be a wild trading session to close out the week. Keep your stops tight.
And keep your eyes on the VIX.
Theta Fuse out.